Joining us now to talk rates and the latest Fed decision is Campbell Harvey. He is a professor of finance at Duke University. He also coined the inverted yield curve indicator in a 1986 thesis. And Professor, thanks for being here today. Let's talk a little bit about the inverted yield curve, because it's gotten a lot of pressure from people saying, hey, it's wrong. It's been indicating recession for a long time. You think they're misreading that indicator. What's it telling you right now? What do you see?
So the indicator is 8 out of 8 in predicting recessions, and it doesn't have any false signals. So one thing is the lead time from the inversion to the beginning of a recession. And if we look at the last 4 recessions, the average lead time is 13 months. So it's way too early to say this is a false signal. Maybe it does turn out to be a false signal, but you can't say it's a false signal when you're not even at the average. So at the average, we would expect a downturn to start in December or January.
December of this year or January of next year? Correct. Because it takes 12 to 13 months before it's going to kick in anyway, and that's about where we're hitting.
And people also say, well, we've seen the yield curve inversion become less of an inversion, so kind of a re-steepening. Well, the last 4 recessions, that happened before the recession. So it doesn't mean that it's a false signal necessarily.
You think a recession is coming?
Yes. So I think that the Fed has made a major mistake. What they should have done yesterday is not just pause, but say, this is it. And indeed, it would have been ideal for them to say, well, this is it. And now the next decision is to decrease the rates, not to increase the rates. And unfortunately, there's a false narrative going on by the Fed that inflation is well above its comfort level. And it doesn't make any sense to me. And let me tell you why. The most important component, the biggest share in terms of contributor to the CPI, which is running at 3.7%, is shelter. And shelter in the calculation is running at 7.3%. And that is far away from the sort of shelter inflation in the real world in real time, where housing prices are flat or negative. Rental costs, if you look at various surveys, those are flat or negative. So if you replace that 7.3% in the CPI with a more realistic number, like 1%, which is what we observed today, 0 or 1, then the inflation is not 3.7%, it is 1.5%. And if you believe shelter inflation may be a little higher, like 2%, then the inflation rate is not 3.7%, it's 1.8%. The point I'm making is this quote unquote long way to go that we hear from the chairman, that doesn't make any sense. And I'm not talking about a special inflation gauge where you trim certain things or you throw food and energy. I'm looking at the regular, the basic inflation calculation, but replacing one very stale component with real-time, realistic numbers, and we're below 2 right now.
So you think inflation is not nearly as bad as the metrics that the Fed is watching. You think an economic recession is much closer than other numbers might suggest, or numbers that the Fed might be watching. You're a respected professor, Harvey. You're a very respected Professor Harvey. Why don't you think there's more of a traction with that picking up? Why don't you think that message is getting related more often?
People want to believe that we can avoid a recession. I actually hope we can avoid a recession. Like, nobody wants a recession. But if you look at the fundamentals in the economy, so 2023 looks pretty good for GDP growth. But if you look into the numbers, it's driven by the consumer. The consumer bailed us out in 2023, and that's a result of a lot of savings that were built up during COVID and some government help. But those savings have been driven down and are likely to go close to 0 by the end of the fourth quarter. So consumption is not going to bail us out in 2024. The other important component, investment, well, that's already negative. So in 2023, investment spending, the growth rate is negative. It's almost like we're in an investment recession already. So you put those two things together for 2024, and it spells very low or negative growth. Hopefully, a soft landing.
How deep of a recession? Yeah, how deep of a recession do you think one is coming?
The question is how deep. And every time that the Fed increases rates, it increases the probability of a hard landing. And we all want to avoid the hard landing. And it is possible to do that. And I wish that they would look at the data to understand the actual CPI and realize that in the future, that 7.3% is rapidly going to come down to something like 2%, and inflation will be within their range. But instead, they've got this one lever, and that's increased rates, and it increases the probability of a scenario that nobody wants. I do think that if we do pause and maybe start to decrease, we can avoid the worst possible case.